Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Tuesday, everybody. First up, a quick economic update of concern. According to new data from the State Administration of Foreign Exchange, SAFE, foreign investors pulled a record amount of money from China last quarter, likely reflecting deep pessimism about the economy. China's direct investment liabilities in its balance of payments dropped almost $15 billion in the April through June period, marking only the second time this figure has turned negative. It was down about $5 billion in the first 6 months. Analysts were quick to point out that should the decline continue for the rest of the year, it would be the first annual net outflow since data has been available going back to 1990. US-based Bloomberg, reporting on the numbers, writes that foreign investment into China has slumped in recent years after hitting a record $344 billion in 2021. Quote, "The slowdown in the economy and rising geopolitical tensions has led some companies to reduce their exposure, and the rapid shift to electric vehicles in China also caught foreign car firms off guard, prompting some to withdraw or scale back their investments." End quote. The fall comes despite Beijing's growing efforts to attract and retain foreign investment, following the smallest increase on record last year. The government wants to show it remains open and attractive to foreign businesses, in the hope that companies will bring advanced technologies and resist pressure from the US and elsewhere to decouple from China. A major contributor to the net outflow in the second quarter was a $22 billion decline in foreign investors' holdings of Chinese corporate debt, the largest drop on record, according to the SAFE data. SAFE numbers also showed that net overseas funds allocated to Chinese equities dropped to $7.3 billion in the second quarter from $10.7 billion in the same period last year. This was largely in line with a UBS report released last week that showed foreign holdings of Chinese stocks remained low in the April to June period. Chinese stocks have underperformed major benchmarks around the world for at least 5 years now. Meanwhile, Chinese outbound investment also hit a record, with firms spending $71 billion overseas in the second quarter, up more than 80% from the $39 billion in the same period last year, suggesting that Chinese investors are chasing better returns overseas. And this theme of outbound Chinese investment brings us nicely to our next development. Recent violent demonstrations in Gwadar, a key port city in southwestern Pakistan, have highlighted concerns about the country's security situation and potential impact on Chinese-funded mega-projects. Despite Pakistan's efforts to improve security at China's repeated requests, the situation appears to be worsening, with rising unrest targeting critical Chinese projects under the Belt and Road Initiative. Regular viewers will remember that we have covered the rising numbers of attacks on Chinese nationals and projects in Pakistan in recent years. Observers warned that continued instability could pose serious challenges to the Gwadar port and the China-Pakistan Economic Corridor, CPEC, a flagship project within the Belt and Road Initiative and a symbol of the close partnership between China and Pakistan. After the shock of Venezuela in 2015 through 16, Pakistan may be the second big lesson for Beijing on how developing country investment can be much more difficult than first appears. For years, China lent to Venezuela with few policy conditions, securing their loans with loan-for-oil deals and wagering that Venezuela's oil production capacity was a sufficient guarantee for debt repayment. Starting in 2007, former Venezuela President Hugo Chavez agreed to $50 billion in credit lines and loan-for-oil deals with China. A rout in oil prices and declining output from Venezuelan fields meant that Caracas was forced to ask for grace periods on debt owed to China in 2016. This was quite a shock to Beijing at the time, and many argue led directly to a re-examination of overseas investment through Belt and Road initiatives. Tensions in Gwadar escalated after protests led by a Baloch ethnic nationalist movement from Balochistan province clashed with security forces protecting the port project. The The Pakistani army condemned what it described as unprovoked attacks by a violent mob. Gwadar, located in resource-rich but impoverished Balochistan, is seen as the centerpiece of the $60 billion China-Pakistan economic corridor launched over a decade ago. The presence of Chinese firms and workers associated with the corridor has made the port city a focal point for protesters. Ethnic tensions and separatist sentiments have long been prevalent in the region, with some Baloch people saying they are marginalized compared to Pakistan's largest ethnic group, the Punjabis. China has expressed concerns over the security situation in Gwadar. Diplomat Liu Jianchao, during a recent visit to Pakistan, highlighted security threats as the main challenge to the CPEC corridor cooperation, warning that the deteriorating situation could smash the confidence of Chinese investors. Yun Sun, a specialist in China's Belt and Road projects, pointed out that security risks in Pakistan have been a persistent obstacle for Chinese investments. With the situation worsening, China may be forced to be more selective in its projects in Pakistan, particularly as CPEC enters a new phase requiring increased Chinese presence. Commentators have noted that the increasing violence and anti-China sentiments in parts of Pakistan, including Gwadar, are challenging the country's ability to protect Chinese interests. Recent attacks, including a deadly suicide bombing in March that killed 5 Chinese engineers, have led Beijing to urge Islamabad to take stronger measures against militant violence. Despite these challenges, both China and Pakistan have strong incentives to maintain their close ties. Beijing values Pakistan's strategic role in countering India, while Pakistan relies on Chinese investment and diplomatic support. Next up, economist Michael Spence is the Philip H. Knight Professor of Management and Dean Emeritus at Stanford University's Graduate School of Business. In 2021, he received the Nobel Prize for his work in the field of information economics. Over the weekend, Spence gave an interview to Hong Kong-based South China Morning Post as part of their Open Questions series. To end today, we will examine the main observations from this wide-ranging interview. If you enjoy today's video, don't forget to hit the like button, and subscribing is a tremendous help as well. About 40% of regular viewers are not subscribed. If we can get that below 40%, that would be a great push for the algorithm. Thank you so much. Spence begins by addressing the ongoing shifts in the global supply chain, particularly in the context of the US-China rivalry. He acknowledged that while China remains an integral part of global manufacturing, its dominance is slowly waning. Quote, "There is no replacement for China at the moment. It will take considerable time before we can definitively say that China is no longer the world's factory." End quote. He pointed out that this gradual decline is not just due to external pressures, but also China's own economic growth and the rise of other economies, notably India. Spence suggested that over time, manufacturing capabilities will become more dispersed across various regions. However, he cautioned against expecting an extreme shift, noting that such a transformation would be prohibitively expensive and logistically challenging. Spence compared China's trajectory to that of the United States, which once held a dominant position in the global economy before experiencing a steady decline. He emphasized that China is likely to follow a similar path, though its decline will be relatively slow given its current status as the largest trading partner for many countries. Spence also discussed China's strategy of promoting internal circulation as a means to drive domestic growth. This approach focuses on bolstering domestic demand and reducing reliance on external markets. Spence acknowledged China's significant investments in innovation and its potential to generate substantial growth from within. Quote, "China has made heavy investments that will alter the structure of its economy and enhance its already high innovation capacity." End quote. When asked about the future of Hong Kong, he acknowledged that China's influence over the city has grown, but this does not necessarily diminish its role as a global financial center. Quote, "The most likely scenario is that Hong Kong will remain an international city with distinctive characteristics relative to the big cities in mainland China." End quote. He emphasized that Hong Kong's future largely depends on the strategic decisions made by the Chinese government, particularly whether it will maintain Hong Kong's unique status or integrate it more fully into the Greater Bay Area. Spence highlighted the significant challenges China faces in its current economic transition, particularly with regard to aggregate demand and the ongoing real estate crisis. He described China's economic situation as almost the opposite of what is happening in developed countries, where supply struggles to keep up with demand. In contrast, China is grappling with a shortage of aggregate demand, leading to a deflationary environment. Quote, "The solution lies in addressing the imbalances and overcapacity in the real estate sector." End quote. He noted that a significant portion of household wealth in China is tied up in real estate, and restoring consumer confidence is critical for boosting demand. Spence predicted that it could take 2 to 3 years for China to overcome these challenges and return to a more balanced growth trajectory. On the subject of de-dollarization, Spence discussed the increasing use of China's yuan in global trade settlements. While he acknowledged that the yuan's role in international trade is expanding, he emphasized that the US dollar remains the dominant global reserve currency. Quote, "There really isn't at the moment a substitute for the dollar," end quote, he stated, noting that the yuan's role will likely grow over the next decade, particularly with the development of digital central bank currencies. However, Spence pointed out that China's capital account is not fully open, which limits the yuan's potential as a global reserve currency. He suggested that while the internationalization of the yuan will continue, it will not displace the dollar in the near term. Spence also reflected on the future of China's Belt and Road Initiative, a cornerstone of its global economic strategy. He acknowledged that while the Belt and Road Initiative remains a significant tool for China to exert its influence, its future growth may be constrained by current geopolitical tensions. Spence noted that China has learned valuable lessons about negotiating overseas investments, but that the initiative's expansion is uncertain given the global geopolitical climate. Quote, "The Belt and Road Initiative has the capacity to dramatically increase not only development and infrastructure but also connectivity to the global economy." End quote. However, he noted that the initiative's progress is now in question, particularly in light of recent geopolitical developments, such as Italy's withdrawal from the initiative. Spence addressed concerns about China's overcapacity, particularly in the context of its leadership in green technologies, such as solar energy, electric vehicles, and battery technology. He expressed concern that Western countries' restrictions on imports of these technologies could hinder global efforts to address climate change. Spence advocated for foreign direct investment as a means to share technological benefits while advancing global sustainability goals. Finally, Spence discussed the transformative potential of artificial intelligence in the global economy. He predicted that AI will play an increasingly central role in various sectors, driving significant productivity gains. While the US currently leads in AI innovation, Spence noted that China is not far behind, despite facing restrictions on semiconductor technology. Quote, "By the end of this decade, we're going to see large parts of the economy running with the benefit of artificial intelligence support mechanisms." End quote. He highlighted the potential for AI to enhance inclusiveness and improve access to services, particularly in underserved regions. In conclusion, Spence emphasized the complex and evolving nature of China's economic landscape. While China faces significant challenges, particularly in terms of domestic demand and real estate imbalances, its continued investments in innovation and technology position it well for future growth. So, of the interviews with economists we have covered in recent weeks, Spence has been one of the more optimistic voices. We will see in the coming years whether this optimism is well placed or not. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Tuesday, and I will see you all tomorrow.